So it's time for another Repo Madness update. Things were supposed to be more under control now that the Federal Reserve was doing not QE and expanding its balance sheet. I believe they lowered repo down to 75 billion per day. And the data that's coming in, it's not saying that. So today, officially, the Fed is saying on its website that it accepted around $104 billion in overnight repo, and then the 15-day term repo of 30.65 billion. So add that in with the overnight repo amount, and you get over $100 billion. So they topped out at 73.5 billion today for overnight repo. But there's another data discrepancy, and it's all over Twitter. So Jim Bianco, who almost got a job at the Federal Reserve, and he is not a gold bug, and he has publicly disclosed that he's buying a lot of gold on dips, he just put out a chart today. It's on his Twitter. It's in the Wall Street for Main Street Facebook group. You can see it on your screen. I made about 10 different attempts to try to get it there so it wasn't blurry. It's really difficult to fit everything in there for you. He said that the Fed actually did $205 billion today of repo, not the $104 billion that's being reported. So there is a data discrepancy, and he says his data is directly from the New York Federal Reserve, and he calculated the number differently, and he says that today is actually a record total amount of repos in one day, breaking the end of the quarter, September 30th repo day, for $202 billion. So according to Jim Bianco, not according to Jason Burak, according to Jim Bianco, who gets paid big amounts of dollars to do this, who has a very successful global macro newsletter, who almost got a job at the Federal Reserve. That is how well respected he is on Wall Street. He was interviewed for a job at the Federal Reserve. It probably would have been a pay cut considering how well he does. But he says that the overnight repo was actually $205 billion today. And it set the quarter-end peak. It broke the quarter-end peak of $202 billion set on September 30th. So we have another data discrepancy. On top of this, and I was planning on doing another update on this, we have the Federal Reserve balance sheet update today. So I ran the numbers. The Federal Reserve balance sheet at the end of markets yesterday. Let me pull up the right chart. I have a bunch of charts open. Give me a second. Okay, so at the end of markets yesterday, which is the day after the Fed started the not QE program, I believe, $15 billion in initial purchases of not QE, the Fed's balance sheet now is at $3.966471 trillion. That is up from $3.759946 trillion at the end of August 2019. So I ran the math for you guys. In only 6 weeks, the Federal Reserve's official balance sheet is now increased by over $206 billion. But they told us that nothing would be added to the Fed's balance sheet once Repo Madness started. I'll repeat this. They told us ad nauseum. I remember for days and weeks and other people in the gold community saying they're not going to add to the balance sheet. Why are you talking about this stuff? Well, no one's bringing it up now because the balance sheet is up over $200 billion in 6 weeks. But repo is only temporary. It's only overnight. More lies. The only way we'd find out the truth is with audits, real independent audits, and the Federal Reserve is not going to allow that to happen. Meanwhile, the dollar index is down to below 98. It's the first time it's been below 98. Let me look up the chart really quick. Hopefully this will not freeze or anything like that. It's the first time it's below 98 in... Pull it up. First time it's below 98 since the end of August. So the dollar index is at 97.58. However, and we have another divergence here, the trade-weighted dollar index, which the Federal Reserve monitors, which is the dollar versus emerging markets, that is almost back near an all-time high again. So the trade-weighted dollar index had been correcting a little bit. It was at an all-time high on September 4th at 131.5789, and then it corrected, and now it's back up above 131 again by the beginning of October. So it's at 100. It's the first time I've looked at it in a little while. Today it's at 131.09, but it got on October 2nd to 131.3435. So this is hurting emerging markets. So in spite of all these games that the Fed is playing with balance sheet expansion, that repo madness would not add anything to the balance sheet, the truth is otherwise. Even the Fed's official balance sheet has increased. It's increased a lot. 200 billion, over 200 billion, over 205 billion in 6 weeks is a lot. To put things in perspective, I believe QE1 was 600 billion. So the pace, I'm not saying it's guaranteed the pace is going to continue, but we were told that none of this repo stuff, as soon as it came out on September 16th, it started to leak out about the repo stuff. I'm sure behind the scenes, everyone knew about it soon. Everyone in the financial industry with security clearances at the Treasury Department knew about it before September 16th. But we started to find out about it. Financial professionals did, and on Twitter and elsewhere, September 16th. The articles came out on September 17th for the first time. And we were told, what are you worrying about repo for? It's only overnight, no big deal. And yet here it is. The official balance sheet is now over $200 billion in 6 weeks. So you can't say everything is only temporary anymore. The balance sheet is up significantly. It's almost back to $4 trillion. Another couple weeks, it'll be over $4 trillion again. If it continues on the same pace. Another couple weeks, it'll be up over $300 billion in under 2 months, or barely 2 months, if it continues on this pace. So something smells rotten in Denmark. The stuff doesn't add up. Jim Bianco ran the numbers, and his numbers of today's repo injections, total amount of money injected into repo market by the Fed today was $205 billion, not the number on the New York Fed website. Even though he said his source is Fed data, maybe he looked at other pages, other website releases and info releases. So this is not me speculating. This is not me making up numbers. This is a trusted researcher who gets paid a lot of money to produce this research coming up with the data. How come gold is correcting? This is why paper price manipulation is done. It's to protect the dollar. In the short term, anything can happen to gold. What do you think automatically that as soon as the Fed announces balance sheet expansion that gold's going to 2,000 and you're going to get rich? That's not how things work. If you've been in the gold market longer than a week or a couple months, you realize that that's not how things work in the gold market. If you've been in the gold market, if you've been in the gold market long enough, this is not financial advice, just my opinion. If you've been in the gold market long enough, and I've been here over 10 years, you realize humility and patience. And you never buy all of your position in metals for physical gold, physical silver, for insurance savings, wealth preservation. You never buy everything at once. You never buy all your gold and silver stocks at once. Because in the short term, they can knock prices down. The Fed balance sheet could go up another 100 billion, and there's people now saying that gold's not gonna. I just saw a tweet out from another global macro guy saying that gold's dead for the next 3 or 4 months. I don't agree with him, but we'll see. We'll see what happens. I don't do short-term trading on gold. There's a reason for it. There's a reason I don't do short-term trading. If there is paper price smashes, I'll buy more metal. I don't buy metal on up days. I wait till the price is smashed if I want to buy more metal for myself, for savings and insurance. If good stocks, good gold and silver stocks I like, if they get smashed, I just buy more shares. And that's how I get doubles or triples in some of my shares. It's patience and humility. I don't try to time the market perfectly because I realize the games that can be played. That the people running these markets, manipulating, intervening in these markets, they know that gold should go up on days where the balance sheet is expanding, the dollar is weak, and that's why they smash it. That's why they're in there at 2 or 3 a.m. hurting the, blowing out the stops. Massive spike in open interest. That's why they do it. It's been this way for 10 years. Now, the difference is that when there was big smashes 10 years ago, they took many months, if not a year, to recover from. Now it takes weeks. That's the difference, I would say. So, on yesterday's McIlvaney Weekly Commentary, there was some interesting discussion on there about the repo markets. I didn't know this. So, the Bank of New York Mellon is actually one of the main custodians for the repo market. And the CEO, this is discussed. I'll put the video at the end of the show after the show's over, so you can listen to it for yourself on YouTube. But the CEO for the Bank of New York Mellon is now leaving to go take over Wells Fargo. I guess he got a big pay increase, but it sounds like there could be some headaches at the Bank of New York Mellon because they are the custodian in charge of the repo market. So the Fed better hurry up. The Fed better hurry up if it wants to calm down the market and announce that permanent repo facility, because the banks are not trusting each other. They are not lending to each other. There was another spike in the overnight repo rate recently. Not as big as the one that initially got the coverage about a month. Actually, it is exactly a month ago. So the stories, the overnight repo rate on late night on Tuesday, I think September 16th, that's when the overnight repo rate went up about fourfold, and that started to get the coverage. We didn't get as big of an overnight repo spike today, but there was a spike. So listen to what David McIlvaney and his show co-host have to say about that podcast. And there's a couple blog articles about the Bank of New York Mellon. They have like this online magazine on their website talking about their exposure in the repo market and how everything was being centralized at a clearinghouse, and that would allow the amount of repos to expand. I have an article about it if you want to read it. It looks like starting in early 2017, the Bank of New York Mellon, once the money market sponsored repos started going to a clearinghouse and the Bank of New York Mellon started getting aggressive in the repo market, the amount of repos in billions went from 0 in March of 2017, and it rapidly started going up. It got to 50 billion by mid 2018, and they got it up almost to 100 billion a couple years later in early January. So they aggressively started leveraging that up because I guess they figured that once it was at a clearinghouse, that the taxpayer and the Federal Reserve was on the hook for any of the screw-ups and the losses. The Federal Reserve also cares about the stock market because of capital gains tax revenues. So They may let the stock market crash. This is my opinion. They may let the stock market crash for 6 months, 12 months, maybe at most 18 months. But then it really starts to hurt the capital gains tax revenues. And the U.S. Treasury relies very heavily on capital gains tax revenues for stocks, bonds, and real estate. If you look at a chart, if you go on the St. Louis Fed website, and I've talked about this in videos earlier this year and last year, I showed screenshots with this chart. But if you go back and look at the annual tax revenues for the U.S. federal government, they got cut in half in 2008, and that blew a hole in the Treasury's budget. So that's why the central planners, the Federal Reserve, and other central banks, That's why there's going to be more and more intervention, more and more rules changes. The Fed is already doing more not QE preemptively. Look, the U.S. technically is not even in a recession, and they're already cutting rates. They've cut rates twice, and they're going to probably cut rates again at the next meeting or Fed meeting or two. Yeah, the bond bubble is very serious, though, because of the corporate debt, how much corporate debt and the government debt. But the stock market is also important from a capital gains tax perspective. And also, if the shares are falling, then the companies might not do stock buybacks, because the companies tend to not do stock buybacks when the shares are down a lot. A lot of these publicly traded companies that leverage their balance sheets with debt, they tend to not buy their stock with buybacks on dips. They actually do more buybacks when the share price is high. ExxonMobil was one of the worst ones. ExxonMobil did many, many billions of share buybacks with debt on a cyclical business where the commodity price can fluctuate. They bought back many billions of dollars in shares with debt at $90 per share. I got a couple super chats today, too. Thank you, Greg. I appreciate it. Thank you, Paul. Appreciate it. There's a couple articles talking more about why the repo spike occurred. If you want to read them, I'll put them in the information and description section of the video. I'm not going to read these articles. Just going to do a short little update here. Yeah, so there's a big discrepancy now between what the New York Fed has, the data that the New York Fed released today for the repo, and what Jim Bianco is saying. I would like a clarification from Jim Bianco on why there's a $100 billion difference. Because Zero Hedge has screenshots of the amount, and I have the New York Fed repo amount website up today that's supposedly accurate with its disclosures, and it says 104 billion, and Jim Bianco is reporting 205 billion today. And Jim Bianco is not a conspiracy theorist. On his Twitter, I checked his Twitter before I went on. I did not see him explaining the discrepancy between the number that says 104 billion versus his number in 205 billion. 100 billion is a very significant data discrepancy. So the Fed will probably sooner than later announce the permanent repo facility. The estimates are it's going to be around 300 billion minimum. And there's some good fan art for the thumbnail after the video's over. Shout out to Emery, who made the Repo Madness thumb art. You can't see it on your screen right now. Come back to the Wall Street for Mean Street channel after this little update's over and take a look at the fan art. It's really cool. He did a good job on it. So there's stuff that just doesn't add up. Oh, thank you for the super chat, Eric. I appreciate it. Yeah, I mean, gold's still hanging. Look, gold didn't get smashed too bad. Gold's still hanging a little bit below 1,500. Still at 1,492. Silver's at 1,753. If oil prices keep going lower, the miners are going to make decent margins. The problem is they've had a bear market for so long that a couple quarters of good margins aren't going to solve all their problems on their balance sheet. Despite paper price smashes, I mean, the gold price is still above 1,450. They haven't gotten it below that. It's still hovering around 1,500. So we could see it consolidate. It looks like we could see it consolidate for a little bit longer. Even the bad news or attempts to smash gold price are not smashing it as much as they used to. It's still holding pretty solid. Might go a little bit lower. 6 months from now, it could be a lot higher. We'll see. I'm not a short-term investor, though, in gold and silver, so I don't really care. I already talked about my personal philosophy, not financial advice, just my opinion. Full stupid disclaimer on what I do with my own money for gold and silver. It's really funny, though, if you read the press releases from Bank of New York Mellon talking about this, centralizing everything at a clearinghouse, they make it like that solved all these problems, but it seems like from the amount of growth that Bank of New York Mellon did in the repo market with loaning with money markets and hedge funds, and it talks about this in this article from June that I have on their website, that I found on their website, that they massively increased the amount of exposure they have to repo loans and the amount of leverage involved in them. Because they took a market that was non-existent, taking money market savings and then hedge funds who wanted leverage and merging them together for new transactions in repo. And then they started doing what, 100 billion? Yeah, 100 billion per month. Some months it was more than 100 billion. So I'm wondering if the CEO of Bank of New York Mellon saw that this was going to be a problem in the not too distant future for Bank of New York Mellon, and he's taking his golden parachute out now for a higher salary and more stock options at Wells Fargo Bank. Wells Fargo is a bigger bank. I'm sure they can pay him even more money. It had to be more money, didn't the Samantha ask? It had to be more money, didn't the repo interest overnight repo rate spike over 2% even after all the money given? Yes, it did. It did, and there's hedge fund people that are worried about that. It means the banks don't trust each other because the banks could theoretically earn a very low risk extra profit for just an overnight loan, and they're not willing to do it. Doc Holliday asks, with all the Fed spending, government spending, and all the shitty news, why is silver at $17.50? Announce you just don't have a clue why. This is welcome to the silver and gold market. This is just how the paper metals prices work. Silver moved up from under 15. There was people who listened to this podcast who were commenting every single show saying that silver would never be allowed to go above 15, gold would never be allowed to go above 1200. Then the guy sent me a page-long email saying, gold, you were wrong, you're wrong. Gold would never, I didn't say gold would never be allowed above 1200. I said gold would never be allowed above 1400. He wrote me an entire page of this stuff with insults and other stuff. And then asked me if I knew what the Gold Antitrust Action Committee was. I've interviewed pretty much all those guys multiple times. He must not be familiar with my work at all. The only person in GATA I think I didn't interview was Adrian Douglas, who passed away from cancer. This is just how the gold and silver market works. Normally there's not big moves in the metals prices, not yet. But they can't smash it, they can't cap gold at 1,000 or below 1,000. All the miners would go bankrupt. They can't cap silver at 10. All the silver miners would go bankrupt. There's limits to the paper price manipulation. When you cap paper prices in metal, it becomes a price control. And what happens with wage and price controls when the market is set artificially low for price? There become shortages. First, what happens is the miners don't invest in exploration. And if you talk to most of the mining companies, most of the mining companies have cut or totally eliminated their exploration budgets to the bone. There's a lot of mining companies out there that have spent little or no money on exploration for the last 6 years. In the short term, no one cares about that. In the long term, it's important. So you're not going to see a big spike probably in a couple weeks or a couple months for a silver price going to $25, $30. You're not going to see that. You're going to hear the people in the gold and silver community, they're going to run this, oh, Fed balance sheet is up $200 billion in, 6 weeks. They're lying about repo. Gold's going to 2,000 soon. Silver's going to 50. Maybe. It's a low probability event. Would I bet money on it? On a short-term trade for that happening in the short term? No. I have long positions. I have metal. If it goes up there, great. I'd be happy. Will I bet money that it's going to happen in 6 months? No. I won't bet money that we're going to have gold at 2,000 in 6 months or silver at 50 in 6 months. I won't bet money on it. You're not seeing me buy out of the money call options and the most riskiest junior miners betting on that. But there's people doing it, and there's people taking a lot of advertising money from juniors to pump that stuff. Okay, well, I think I covered everything that I wanted to cover. I want to thank all my 170 now Patreon account contributors, and I think it'll be 200 probably in the next couple months. We have had 5-fold growth in the last 6 months. Pretty amazing. So thank you very much. And I'm working on some really good content. I am working on about a 10-minute short video with slides and analysis to show the US and China trade negotiations update. And this is going to remove all the bullshit from the press releases from both countries. This is going to include my sources in mainland China and other hedge fund sources with good China contacts, and summarize a lot of the articles that just people don't have time to read, and what each country cares about the most, or specific individuals, whether it's Trump's trade advisors, two main ones, or President Trump, what he cares about the most, short-term and long-term, and Xi and some of the other people involved. Also, the Canadian government's involved now. So China's retaliating against them too. Because, and I don't know how much you're going to hear this in the mainstream media, but a lot of these trade negotiations, China, one of their main demands before they actually would agree to anything is a lot of it centers around Huawei. So I'm working on that. I'm working on a couple other things. Supposedly I helped Kyle Bass get another interview with Peter Schweitzer from Secret Empires. So that may be on Real Vision TV soon, I'm hearing. I'm hearing he bought that book, Secret Empires. He's reading it now and loves it. And there may be an interview for that on Real Vision Television. I'm going to try to leverage, now that I'm in his good graces for recommending the book, I'm going to try to leverage that into an interview for Kyle Bass for this channel. So the mainstream financial media here in the US, mainstream financial media does not, even China Uncensored, I think, doesn't cover this enough. The analysis of what's really going on in the trade war, trade negotiations, because they don't talk about Kyle Bass and Lighthizer in their history, and how much China cares about the Huawei CFO and Huawei, and how HSBC Bank and Standard Chartered Bank and two other large U.S. banks were also involved. There's some really interesting stuff going on with the HSBC, Huawei stuff that's involved in the China trade negotiations that you're not going to hear mentioned on the mainstream financial media. Okay, well, that's it for right now. Thank you, everyone. Gonna go relax and watch this playoff baseball game and work on the rest of the content. Maybe I'll have it out later tonight. We'll see. If not, tomorrow.